Great. So, come you all once again to today's section. Today we are looking at a practice section of internal rate of return, and then we will look at the decision rule of internal rate of return. Yeah, that's the acceptance criteria. On what basis do you accept project or using the internal rate of return? Good. So basically, that's today's section. So let's look at the question called Kwame. That's the question, Kwame. Great. Okay. So this is the question that we are going to do. Good. So let's see. Required. You are to calculate the break-even rate for the project. Break-even rate for the project. So now let's see. Kwame, after his national service and with no hope of securing a job in the formal sector, has decided to run a taxi service. The following forecast has been made for the operation of a service between Abyssum and Sunyani. Good. So item number one, revenue totaling 300 a week for 52 weeks in a year. This is net of what? Fuel and other variable costs. Great. Ties, 4 pieces for a year at 120 per unit. Maintenance and services, 120 per month. Salaries, 3,000 per year. Insurance, 350 Ghana cedis per year. Good. The net cash flow will increase at 5% per annum for the next 5 years due to inflation. The cost of the vehicle is estimated at 28,000 cedis. The project appears quite profitable based on MPV criteria using the government policy rate of 26%. However, the banks are offering rates far higher than the policy rate. Good. So you are required to calculate what? The break-even rate. We said that the internal rate of return is what called the break-even rate. The internal rate of return is also called break-even Right. So that's the internal rate of return. So let's see how best we can calculate this. So now let's go to the board. We said that with the internal rate of return, it's a guesswork. We have to guess two discount factors and calculate what the NPV at the both section. And they use it to estimate the rate. Internal rate of return is a rate that render NPV to be zero. Great. With the internal rate of return, it is the rate that render the NPV to be what? Zero. So it's a special rate. So anytime you calculate NPV and then NPV is equal to zero, that discount factor, that special discount factor is called internal rate of what? Return. Good. That is it. So anytime NPV is equal to zero, the discount factor is called internal rate of return. Great. So basically, that is the internal rate of return. It's a rate that render the NPV to be zero. Then we are done. Okay. Or now the internal rate of return can also be defined or explained as conducting a sensitivity analysis on the cost of capital. Great. So that is it. So let's see, Kwame. So to calculate the internal rate of return or the break-even rate, I just have to tell Kwame that we need to NPV at different or discount factors. So we will start. So internal rate of return, right on board, on top of it. Great. Then I'll tell the examiner that I need two rates, discount factor. So let rate A be what? Let's assume any discount factor. Okay, so 10% as usual. Good. So therefore, comma, NPV A will be what? So NPV what? A. The first NPV will be, let's go and calculate it. So from there, then also tell the examiner. Then let's rate B be equal to that one we don't know. So that one we can't say anything for now. So NPV B will be what? That one we don't know for now. Until the result of what? The discount factor A or the MPVA. Great. So this is what we want. So now let's calculate the MPV. So therefore, calculation of the MPVs. But before that, we have to estimate the cash flow first. Okay, good. Or we can also say that let's the second rate or let first rate be 10%. Let rate A be what? 10%. So let rate A be 10%, or let the first rate be 10%. So therefore, NPVA will be what? You put it down. Then tell the examiner. Then let rate B be equal to. So we can just make it equation to avoid trouble. Like how I did the second one. So first, let us examine the let rate A equal to 10%. We are done. And PV A will be what? We've not solved that one yet, so we are about to do that. Good. Then let rate B be equal to what? That one, that answer too depends on the other. So now let's go and estimate the cash flow. So net cash flow. All right, net cash flow. Now let's go to the question again. It states this. So revenue totaling what? 300 Ghana cedis a week for 52 weeks in a year. So I'll go and write revenue and estimate the revenue for a year. So I write here Ghana cedi. We are just estimating the net cash flow. So revenue will be bracket. I open a bracket. I said 300 Ghana cedis for 52 weeks, so times what? 52. So what will be the answer? Great. Now this project will last for 5 years. Just that these cash flows are constant. The cash flow will be the same for the 3-year period. So we can just estimate one net cash flow and use for the period. This is the same case as the last question also talks about. So question like this one is the same. Even though you are going for 15 years, the cash flows are the same, repeated each year, constant. We call it constant cash flow. The cash flows are the same. So for that one, you don't need to show all the 15 years. Just get a net cash flow for a particular year or for just for 1 year and then cumulate it or multiply by the number of years that you are going. Exactly. Or find a cumulative discount factor. That's all. Good. Then let's go back. So that is it. So please, what will be the answer? Good. So you get 15,600 to be the revenue. Perfect. 15,600. Let's continue to do the estimates. Don't forget that we are using the relevant cost. The next item is ties. 4 pieces for a year at 120 per unit. So each year you buy 4. So 4 by what? 120. So tie will be what? Running cost. So right here ties. So ties brackets 4 pieces by 120 Ghana cedis. And that'll give us 480, right? Great. So I'll put it here 480. I'll move on to the next item. Maintenance and servicing 120 per month. 120 per month. So maintenance and servicing. So maintenance and servicing. 120 per month. So how many months do you have in a year? So 120 Ghana cedis times 12 months. And that'll give us 4,000 for 0. Agreed. 1,440. Great. So that is it. Now let's move on with the game. Then salaries, 3,000 per year. So each year will be what? 3,000. Great. So I write it here. 3,000. I bring it there. Great. So salaries is what? 3,000. The next item on the list, insurance, 350. So insurance 350 per year. So therefore, I write insurance here. Insurance. Insurance is 350. So I'll put all of them together. Then I'll get a net cash flow. Good. How we get it? Good. So what will be the net cash flow? Then we will go ahead to calculate the MPV. So net cash flow. Net cash flow. Sorry. So the net cash flow will be that is 15,000 revenue. In fact, all this one must be subtracted. Why? Because they are running costs. So revenue of 15,600 less 480 less 1,440 less 3,000 and finally less 350. The net cash flow will be 10,000 330. Perfect. I'll take that. So now let's calculate the MPV. Just that there is inflation in this question. That is what? Inflation. They are saying that the net cash flow will increase at 5% per annum for the next 5 years due to what? Inflation. That's all. So how do you treat this? So it means that each and every year the cash flow will be 10,330, but we have to inflate that. So basically, this cash flow will suffer for inflation. So let's see how we are going to inflate cash flow. If if the inflation has not been the question, then this is what we will do. We will put here. So in calculation of the MPV, we just start the examiner. Year 0, year 1, year 2, year 3, year 4, year 5. We just put the net cash flow here, find the discount factor, and get a PV. We are done. But because of the inflation, we have to inflate these cash flows so that we can get what? Inflated cash flow. So let's see how best we can what? Inflate the cash flow. Because 5 years might not contain the space. So I'll descend it down. So instead, I'll do like this. I'll do first of MPV. So first, I'll write here year. Then I'll put a cash flow here. That is the net cash flow. Net cash flow. And the inflation. Then this is the cash flow after inflation. So net cash flow afterwards inflation. Then I will calculate my what? My NPV on it. I want to calculate the NPV here, so let me reduce the size more, okay? So let me write the net cash flow here. Net cash flow, inflation. Then net cash flow after inflation. So net cash flow after inflation. Then I bring the discount factor here. Then I bring the present value. So the first discount factor, 10%. So this is the first NPV that we are going to calculate. Great. So now let's start the game. So I'll put this on a 9 table. Year 0, year 1, year 2, year 3, year 4, year 5. Good. Great. So let's see. Now first, what is the net cash flow? It will be 10,000 for the first 10,330. So it will be the same throughout. So 10,330. Thank God. Okay. So 10,330. 10,330. So this is the net cash flow. The inflation, what's the inflation rate? 5% from the question. So if inflation is at the rate of 5%, then all what you have to do is just add 1 to it. So it will be 1.05. If I year 1, you put 1 there. If I year 2, you put 2 there. Great. So let's go to that section and take that section again. It says that the net cash flow will increase at 5% per annum for the next 5 years due to inflation. So the 5 years ahead of us for the next 5 years. Good. So from now that we are estimating the cash flow, we assume that now it's year 0. So the next year, so that's year 1. So it will be 1.05 to the power 1. Now you can write sorry. Sorry. This throughout. You can write it throughout like this. That's the inflation, 1.05. Then you start. When are you inflating the cash flow from? If you are starting from year 1, you put 1 here, year 2, you put 2. Here will be 3, here will be 4, and here will be what? 5. How we get it? But if the inflation is starting from year 2, then here will be 0, then 1 in that order. So here will be automatically 1, no inflation for year 1. In that instant, the examiner will inform you. He will tell you that the cash flow for year 1 is this, and thereafter it will increase by 5%. How we get it? So the cash flow for year 1 is this, and thereafter it will increase by this. That's the situation. Take note. But here it's not like that. So 1.05, then I'll start by my 1, my 2, in that order. So what will be the inflated cash flow? Kindly get those figures for me. The inflation rate was 5%. So if it's 5%, then it will be what? 0.05. Then we added 1 to it. So plus what? 1. That will give us 1.05. So if I 1 indexes by 1, 2, 3, That means exactly 1 year from us, it will be this. Another year to be that in that order. So that's how come we are at the 1.05. Good. So the first one will give us 10,847. So 10,847. Second year will give us 11,389. Make sure I get the same answer as this. The third year will be 11,958. 958. 12,556. 12,556. Then 13,184. 184. Great. So these are the net cash flows after the inflation. So these are the cash flows that we are going to use to calculate what for that of the MPV. So we can go ahead and calculate the MPV for the first rate. Great. Now to calculate the MPV for the year zero, put the cost of investment there. The cost of investment, which is what? The capital cost of the taxi or the capital cost of the vehicle. The vehicle is for 28,000 cities. So 28,000 cities. Good. So that's the capital cost. So I'll put the capital cost here, 28,000. If you want to inflate that one too, don't worry. You can put it here, 28,000. Inflation will be 1. Because one city today is the same as one city. If you like to, you can still calculate it by saying that, okay, 1.05 to the power 0, because you're in year 0, put 0 there. It will still give you 1. How we get it? Great. So basically, that is it. Now let's continue the game. Let's find the discount factor for that of the 10% to calculate the first NPV. So the discount factor is 10%. So 10% discount factors will be, so year 0 will be 1, 0.909, 0.826, 0.751, 0.683. We are using the discount factor of 10%. Great. Okay. So the last year will be 0.621, right? 0.621. Now what will be the present value? What will be the present value? The present value, we multiply the discount factors by what? The various net cash flow to get the present value. Great. So that is it. Great. So for the first one, you get still 28,000 because 28 times 1 is still 28. 28 times this very one still give us what? 28,000 negative. Then what we do? 10,847 times 0.909. And then what will be the answer? So basically you will get great. Great. So for the very first one, we will get 10,847 times 0.909. Okay, so that'll give us 98 9850. So 9850. Second one will be good. So 11389 by dot 826. That'll give us okay, we had 9902.3. Okay, good. 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 Kindly. So the first one give us 9860. Should be 9860. Then the second one will be 11,389 by dot 826. That'll give us 9407. Then we have 11958 times dot 751. That'll give us 8980. 8980. Then we will have 12556 times dot 683, and that'll give us 8576. So 8576. Then finally we get 13184 times dot 621. That'll give us 8187. 8187. Great. Now basically that is the present value. So now sum all this up. Add all this and let's see the NPV. Finally, so the NPV will be, so let me write here NPV. So NPV will be, so that's the NPVA. This will be the NPVA, the first NPV. So what do you get for the first NPV? Good. So what do you get? Now let's see. So putting all this together, we have 17,010. That is the first NPV. 17,010. Perfect. So the first NPV is positive. What will be the second discount factor? We said that the second rate depends on the result of the first rate. Great. So now I'll come back to my template and put Ghana cedi of 17,010. Now let's get the rate B. Now, we said that if the first NPV is positive, what will be the second rate that you are going to select? So we said that select a rate that will bring the NPV to be what? 0 or negative. Because the lower the discount factor, the higher the NPV. And then the reverse is true. Because cost of capital reduces what? The NPV. Good. So this 10% and the NPV is positive, is even big, 17,000. It means that this cost of capital is too small or is too low. So let's select higher. Higher one will render this NPV to be what? 0. So let's select higher. So let rate B be, let's say 30%. You can select 20. In fact, from 15 going. 15%, 20%, 30, any. You are correct. Any one that you select, you get the same answer. Just that you have to obey the rule or the principle that says that if the first NPV is positive, select a rate which is higher than the first one. If the first rate is negative, then select a rate which is what? Lower. Good. And then you are done. Now let's see. So we have selected 30. So it means that we have to calculate what? A new MPV at a discount factor of what? 30. That's all. New MPV. Good. At a discount rate of what? 30%. We just need the net cash flow, the one that we discount. So it will be this. So from here up to here must be calculated again. So that this 10% must go, and it must be what? 30%. That is all. You can use 20%, you can use 15%. Make sure that is what? Higher than 10%. That's all. If you choose somewhere, let's say 12, 11, 12, 13, maybe 20, the NPV might still be positive. You are not wrong. Still use it to give you the same answer. Just that the NPV will reduce. Good. So that is it. So now let's see. So let's calculate the second NPV. So all what I'll do is, in fact, I'm supposed to do it on a different sheet or different page. So I'll just clean these discount factors and then reproduce them and I'll calculate it here. But please, for the purpose of your examination, if I do it in the exams, don't go by that approach. Go and show a different page and then do the workings there. Or if you go, so that it's a bit more here, could have continued at 30% here and then we calculate the MPV on the same table. On the same table, yes. You can do that. If it had been 4 years, we could have done it the other version. That's the landscape. Good. Okay, so basically that is it. The idea is get 2 MPVs. You are done. So let me take this section off. Then let's calculate new discount factors at 30%. So that we put them in and get a new MPV. So now the idea is we have to use the net cash flow, not the present cash flow that we had, the net cash flow after inflation. Good for this question. So therefore, 30% the discount factor will be, so the year one will be, then you are done. Now the rate A, the first rate is a guesswork. Any discount factor at all you can choose for the first rate, it's a guesswork. Choose any discount factor at all. Choose what? Any discount factor. So the first rate, they've probably selected 20%, 30%, 25%. That's all. But I like dealing with 10%. So that's why I selected 10%. Maybe you like 12%. First discount factor does not depend on anything. It's a pure guesswork. Just that the second discount factor depends on the solution of the first MPV or the solution of the first answer. That's all. Good. So the discount factor for that of 30%, for 30%, year one would be so 1.0, 1.3 to the power minus 1, that will give us. So 0.769. So 0.769. That's the first discount factor. Good. Then the second year own will be 0.512. So 0.512. Then the third year will be 0.455. 55. Then we have 0.350. 0.350. Then finally, we have 0.269. 0.269. Now let's calculate the present value. So 10,847 by what? So 10,847 times 0.769. And that'll give us 8341.
So it's
8341. 8341. 8341 for the first one. Great. So 8341. And the second one now give us dots 512. So times that's of the 11389. I'll give us 5831. So 5831. Then dot 455 times 11958. That gives us 5441. 5441. Then we get something like 556 times dot 350. That'll give us 439695. It will be 4395. 4395. Then we have 13184 times dot 269. That's 3546. So 3546. Then let's sum all together. Let's sum all together. Putting all together, that's 28,000. So minus 28,000 plus 8341 or 8344 plus 5831 plus 544 441 plus 4395 then plus 3546. That gives us negative 443. Wow. Negative 443. Perfect. It's negative. So put this in brackets. MPV is negative. That's perfect. So now we have this. We can now go and calculate what the internal rate of return. Wait, so 443. I will take that. 443. 443. 443. 443. Great. Now let's see. Okay, the negative will not come in. This one is 8341. 8341. Now let's check the year 2. Must give us something bigger than this. 11,389 by dot 512. Okay, I think it's true. Okay, so it's in 3. So 3440. Perfect. So 440. That is great. 440. 440. So discount factor for year 2 must be 0.592. Right, so here must be 592, not 512. So basically that is it. So probably to have slight impact here. So dot 592 times 11389. That gives us 6742. So great. 6742. So finally we will have something like, okay, so it will probably change the whole show. So 6742. So probably it will reduce the impacts. So there's a difference. So that means it will still be what? Positive. Sorry, it will still be positive. So that will be less 440. So I'm getting something like 471 neighborhood. 471 neighborhood. Or you take all of them again. Take all of them again. That's minus 28,000, minus 28,000 plus 8341 plus 6742 plus 5441 plus 4395 plus 3546 plus 35. I don't know. So 465. Great. So do 465 and then so still the MPV is still positive. You have to still maintain it. The MPV is still positive. You have to still maintain, even though we are looking for negative. So that means to get a negative, it must move beyond 30%. Good. So the second MPV is 465. So let's go ahead and calculate. Let me take this section off. So now, what is the internal rate of return? The more I code the formula, the more I remember. So what I'll do is I'll tell the examiner that internal rate of return is nothing by the first rate that I guessed. Now plus open a bracket, the first NPV, so NPVA, I'll then write it in the middle. So NPVA all divided by NPV A minus NPV B, and here B minus what? A. That's the internal rate of return. So you are going to multiply, but times something, multiply by B, rate B minus rate A. So let's do the substitution. Rate A, we get 10% here, so I'll make it 10 plus open a bracket, NPVA. NPVA is 17,010, all divided by 17,010 minus MPVB. Even though B is supposed to be negative, it's still positive. Maintain it like that. So 465. Then times into brackets rate A. That's rate B minus rate A. So 30 minus 10. So 30 less 10. Good. So that will give us 10 plus sum all what's in the brackets. So into brackets, all what's in the bracket will give us something like 17,010 divided by 17,010 less. Okay, so less 10 less 465. That'll give us 1.028. So 1.028 now times what? Times 20 aggregate times 20. So basically you get something like final answer. So this times 20 positive 20, that will give us 20.56. If it's 20.56 plus 10, so plus 10, so it's 30.56. So that's the internal rate of return. We are done. 30.56. Now, what is the acceptance criteria for the internal rate of return? On what base do you accept the project if you're using the internal rate of return? Now, you compare the internal rate of return to the company's own cost of capital. If the internal rate of return is higher than the company's cost of capital, accept the project. If it's lower the company's cost of capital, reject it. This is what we are talking about. Nine does the board. Nine does the board. Good. Now let's back this with illustration. I'll just doing only the first two lines. Now, internal rate of return is the highest rate that any company will be willing to accept for a project. Why? Because at that rate, the NPV is 0. So that's the highest one. Because if the rate, let's assume that here we have 30.56. So exactly at 30.56, the NPV, let's put NPV here, NPV will be 0. So that means the highest rate that any company can accept is what? 30.56 for this project. Because even if I accept 31, I'll get negative NPV. Because at this NPV is 0. So I get negative what? NPV. Good. So therefore, I'll compare between 0 and this. Any cost of capital, I'll accept it. If the company cost of capital is 20%, accept. 30, accept. But immediately it ran after or fall after 30.56, reject it. Why? Because the project will give you loss. So that is the acceptance criteria for internal rate of return. Agreed. Perfect. Now let's quickly do a short analysis here. There's something called capital ration. Capital rationing. So let's quickly talk about it more. Before then, we can jot something down. So, if you do have any question, let me have them. Okay, here we are saying that the acceptance criteria for internal rate of return is that accept projects that have internal rate of return higher than what? The company's cost of capital. Accept project that the internal rate of return is what? Higher than what? The company's what? Cost of capital. That is it. Why? Because the internal rate of return is the highest rate that any organization will accept. Highest one. So if their cost of capital is more more than that, more than the internal rate of return, then they should reject the project. Why? Because at the internal rate of return, at the internal rate of return, NPV is what? 0. Any rate after the internal rate of return, you get what? Negative. If you like, try on your own spare time, just use just use 30.56 to calculate for the NPV for this project. You get 0. And then the next day use 31%, you get negative. Good. So if the company's discount factor or company's cost of capital is within 0 up to 30.56, then they should accept the project. Good. So like we said example, if their cost of capital is, let's say, 20%, oh, then at least we have some marginal gain of 10%, so we should accept the project. Good. So that is it. Great. So if you do have any question, kindly let me know before I take the last section of the capital budgeting to bring the capital budgeting to a successful end. Great. To bring capital budget to a successful end.
Yeah. Very well.
Great. Now let's look at a section called capital rationing. Capital rationing. Yeah. You know, let's assume that you have a lot of profitable projects. All of them have positive MPVs, and we have informed you to select the best one. I suggest strongly that every organization or business will enter into all of them, right? No. But sometimes there will be some resource or the resources are not what adequate. So it may place a challenge or a limit on the project that you can what undertake. That is the capital rush. That means we have to employ the technique of what capital reaction or a strategy. Let us assume that you want to eat. You want to eat, let's say, five different kinds of meal in a week. So maybe first week in January, you want to enjoy well. So five meals. Meanwhile, all that meals will give you different satisfaction and different joy, and all that joy you need them. But the issue is that your money or your pocket cannot sponsor these five different type of meal. So what do you do? Then that means there's a limiting factor here. So when there's a limiting factor in investment appraisal, the technique that you have to adopt to optimize the little resource that you have is called capital rationing. And a limiting factor analysis. We said that we call it bottleneck resource, right? A limiting factor. We use throughput and what? Contribution analysis to determine the optimal mix. Here, what are you going to use? Then do what you call ration the capital, share the capital accordingly. That's all. So that's the topic. So that's why we call it capital rationing. So capital rationing. Good. So that is it. Capital rationing. So it's a strategy adopted by what? An entity where there's what limits on the resources available to undertake what an investment. That is the basic idea or basic meaning of capital ration. Good. So you can define capital ration as what? Strategy. Yes, it's a strategy. So strategy adopted by what companies or investors to limit the number of projects that they can take at a time. Why? Because there's a what challenge on it. There are two types of this capital reaction. So anytime there's a challenge or anytime that is like a factor which prevents you from taking all the profitable projects to good, then you have to ration your capital. So we call it capital ration. Good. So basically that is there are two types of capital ration. You have the hard and soft. Hard capital rationing. Hard what? Capital rationing. Hard capital rationing. Good. Hard capital rationing. So types, there are two types. Hard. It's very hard though. And soft. Very soft. Here, the underlying word is that They are the factors that go beyond the entity's control. Don't have control over. You cannot do anything about it. In fact, you can try your maximum best, but still it will be a challenge. Like you have a limit on amount that you can borrow at the bank. Maybe your mind was on your bankers that they could have probably given you loan to go and then take that project or go and finance that project. You went to the bank and they told you that no way, the maximum amount we can give you is 50,000 Ghana cedis. Meanwhile, you need 75,000 cedis to go and then finance all your 5 projects. All of them are positive. So basically, this will place a challenge in you. So this one is as a result of what? Items that goes beyond what? The control of the entity. That's a hard capital rationing. How we get it. Then we have the soft capital rationing. Here the entity can control it within the entity's control, entity's ability. So like poor managerial skills or the entity's internal budget. Entities what? Internal budget. Every organization have its budget. So next year, we are not going to buy any assets, any capital projects. We are not going to undertake any capital projects. So it can also serve as what? Soft capital ration. This the entity have control over. Yes. So that's a soft capital ration. Then the question is, how do you deal with such situation? Go. There are so many methods, but we use what we call profitability index. So now let's cite an example for ourselves. Let's cite the example for ourselves. Then we are done. So let's assume these are the projects. So projects, all of these are profitable except one. So projects. So project, let's say project ABB, and project BCC, and project CDD, and project DEE, and project EFF. Wow. These are the projects that is on our list. How many? 1, 2, 3, 4, 5. Okay, 5 projects. Let me add one. Project FGG. Great. Project FGG. That is it. These are the capital requirements. So capital requirements. So that is the capital requirement. But that is the cost of investment. So capital requirement for each of the projects. These ones are in thousands. The NPV is also here. NPV. NPV is also here. But I want to create some small. Okay. So create. Uh, but let me continue. NPV is also here. It's also in thousands of cities. So these are the NPV for a particular company. So first, project ABB, the capital requirement is 60,000 Ghana cedis. So that's 60 million. And then the MPV is 12,500. I like that. For project BCC, the NPV is 14,000. But the capital investment is what? 70,000. Project CDD, You need just 10,000 Ghana cedis to sort it out by the project, but the MPV is around 4,000 Ghana cedis. Project DEE, you need just 6,000 cedis. Just that the MPV is what? Negative 1,200. Yes. Project EFF, you need just 28,000 Ghana cedis. But the MPV is just around 6,000 Ghana cedis. The last project, in fact, you need 20,000 Ghana cedis. That's 20 million. But just MPV just around 7,000 cedis. We are done. That's all. Meanwhile, add all this together except this 6,000. What is the total? So let's see. We are doing together. We are deciding the question. So 60 million plus 70 million, that's 130, plus 10 million, 140. This one's not part. Plus 28 million, plus 20 million. That's 188 million. Good. So 188 million. So that is the capital requirement. Now let's assume that your capital or the total funds that you have, the total EPICs, your funds are limited. Let us know you only have 120,000 Ghana cedis available. 100 and what? 20,000 Ghana cedis available. So capital is limited to 120,000 Ghana cedis. So we ask you, what will be the project combination of the projects that the entity should select in order to yield the maximum MPV? This is limiting factor analysis that we are bringing back. So here we adopt the concept of what we call profitability index. You have to rank this project based on their what, the level of profitability. You are done. So that is it. So I'll take this section of the capital limited to 120,000. So let me write it for it. It's worth 120 million. No one trouble. 120 million. Why? Because we fit three zeros here. So it's worth 120 million. So that's 120,000. Good. Now you continue again and then calculate your profitability index and rank them. The profitability index here, you can call it what? You can call it the throughput per limiting factor or contribution per limiting factor. That is it. So PI, profitability index. So let's go. Profitability index. How do you get it? It's equal to the NPV. The formulas are 2 divided by the cost of investment. So cost of investment. That's all. So that's the profitability index. NPV about cost of investment. That's formula 1. Formula number 2 is equal to PV of cash flows all divided by the cost of investment. But we use the formula 2. It's good that you know all the two, which of them or any of them the examiner present the details, you go by it, you are done. So this, in fact, you can use any of these two can work here with this question. If the MPV is 12,500, cost of capital is 60,000, what will be the cash flow? Cash flow will be what? 72,500. So that when we take off 60,000, we get what? 12,500. So just add back the NPV to this one to give you the present value of what? The cash flows, and then you are done. So basically, that is it. Now let's see. Profitability index. Now pick the NPV. So NPV is 12,500 divided by 60,000. So 500 divided by 60,000. 1, 2, 3. I get 0.2083. So 0.2083. I'll go to the next one. 14,000 divided by 70,000. So 14,000 divided by 70,000. 1, 2, 3. That's 0.2. Wow, I like that. 0.2. Mm. The next one is 4,000 divided by 4 divided by 10. That's 0.4. Agreed. Please, this one, cancel it out. Don't even touch it at all because it must be rejected. Rejected. I intentionally got it in. Rejected. It must be rejected. Why? Because MPV is what? Negative. Ignore projects. So you are doing only for projects. So this one is not part of the game. I'll move on to the next one. 28,000. Because the money is not there. You are going to invest in negative projects, eh? Not at all. So the next one is 6,000 divided by 28,000, and that'll give us 0.214. 0.214. So it'll be 0.214. Lastly, 7 divided by 20,000. 7 divided by 20. That'll give us 0.35. Yeah, 0.35. So 0.35. Now when you are done, can you rank them? Can you rank them? Now let me do the alternative for you. The alternative for the profitability index. Assuming that you are using the other approach. For the other approach, the answer you add 1 will come to it. If you're going to use the other approach. What's the other approach? I'll just try the first two. The other approach, we said that is the PV of the cash flows. PV of cash flows all divided by cost of investment. How do I get a cash flow? What? They have subtracted this cost from certain figure and they had NPV of 12,500. What's that figure? So I'll add back to it, right? Good. So the cash flows over here for the first year will be 72,500. Then I'll divide it by 60,000. Yeah, because PV of cash flow over cost of investment. When I do this, so 72,500 divided by 60, 1, 2, 3, that will give us 1.2083. So whichever method you use, the answer will still be the same. Just that here you add, it will be 1. If you try this one too, you add this one back to this, you get what? 84,000. So therefore, 84 divided by 74, that is 8 divided by what?
70.
Divided by 70, good. 84 divided by 70 will give us, that's 1.2. This 1.2. Exactly. So whichever formula that we use, it will tell us the answer. So we can use this answer to determine which formula that you are using. How do you get it? Uh-huh. So basically the same. Then when you are done, then you rank it. Then when you are done, then you rank it. So let's rank it. So ranking. And I was told that for ranking, we are very good. So let's rank them. So this, which one will score first?
0.4.
So CDD scored first, right?
Yeah.
So CDD scored first. Who scored second?
The last one.
FGG. So second.
Okay.
Third is what?
0.214.
Okay, so that's EFF. So third position.
Then
Then
4.
ABB scored what?
4.
Fourth position. Uh, uh. Then this one scored last. So 1, 2, 3, 4, 5, 6. Okay, they're more than. This one scored fifth position. This one is out of the game because it's negative. The examiner bring it there, tell them that they should reject that project.
Okay.
And money is not what? Enough.
Now,
Good.
interesting.
Yes. So if you have just 10 CD to go in for two dishes, and you're thinking of something that you don't like, don't even buy it because the money is not even enough to cater for what you like. Good. So now the combination of the projects, some of the projects are divisible, some two are not divisible. Meaning you can take a portion of it. So you start, you add them, you add them until you get to the 120,000 or the 120 million, then you stop. So 120 million, that's our capital. That's all. So the first project on the list is what? Project what?
CDD.
CDD. So the capital is what?
10,000.
10,000. So you start cumulatively. As and when you are going, then you'll be adding. So I'll start projects. Let's check another one. Okay, that side is okay. Hope you can see from here. So projects, then the capital, and then the MPV. So projects, first on the list, CDD. The capital requirement is 10,000. Then you be going. Then the next one is what? Second project is that's the FGG. The capital requirement is what?
20,000.
FGG, 20,000. And the third one is what? 28 EFF. So third EFF. And then you be counting. As and when you reach your 120, then you stop. So 28,000. So therefore 30. So we have 58. We have 78 more to go. Then the fourth project is what this. We have 78. So the fourth project is ABB. So we can still produce ABB. ABB is what? 60. So if we take the 60, we still have 18 more to go. So when we ended it was 58. So 100 and what? 18. 118. So therefore, the entire capital is what?
120.
So the entire capital is 120,000. So what will be the balance remaining? So therefore, 5, 8 plus 60, 118. Then we take it from 120, right? So left with 2,000. So this 2,000, we use it to partake some of what? The fixed projects. So the fixed project is what? The BCC. So for BCC, you only have to take what?
2,000.
The 2,000. That's all. So BCC, take 2,000 and then you are done. So BCC, we take what? 2,000. Perfect. That is where the projects are what? Divisible. What if the projects are not divisible? So you end here, that's all. You don't need to take what?
The remaining.
The remaining, don't need to take a part of this because you cannot take a part. Now, what will be the total MPV for this decision? The total MPV will be, you add all the MPV over here, but when you go to the BCC, just take 2,000 out of what? BCC, why? 2,000 out of what? 70,000. Then multiply by the MPV of what? 14,000. So that will be 62,000 out of 70. Good, times 14,000. So that will give us 400. So the MPV over here is 400. So you take full MPV for project 1 up to project 4 and just add 400 to it, then we are done. That is the capital ration. We are done. Now this is a single period capital ration. A single period capital ration. With a single period capital ration, for that one, just for a particular period, not for multiple or like 2 or more years. For that one, we have to use what you call linear programming rate to calculate for the shadow prices over here too. Great. So I am done with the capital reaction. Yeah. Then lastly, sensitivity analysis. Then if we treat that, then we are done with everything. Now with the sensitivity analysis, we are just estimating how sensitive or how the changes in any of the MPV variables affect what? Affect the MPV. So how is the MPV sensitive to its variables? That's what we mean by what? Sensitivity analysis. It's one way of incorporating risk into MPV analysis. We can ask you how to incorporate what? Risks. How do you include risks in MPV? Oh, we include risks by conducting 3 items. Then we are done. We include risks in MPV analysis. Let me take this section off here. Here's this section. How do you include risks in MPV? Tell the examiner that in capital budgeting or in investment appraisal, we normally include risks by making the following assumptions or techniques. So one, by conducting what we call sensitivity analysis. Good. Two, by using what we call expected value. That's probability. Expected value using probability. Good. But there are a lot, but these two will be very good for you. And also discount the cash flows. So by discounted cash flows. Can also tell the examiner that by using what? Project specific cost of capital. Wow. Project specific cost of capital. This and then. So I'm just going to sensitivity analysis out and just explain what we mean by sensitivity analysis to end the game. With the sensitivity analysis, we are saying that NPV, particular is to MPV. NPV. How does the variables of MPV, how they relate to the changes in that of the variables? How does the MPV react to that? So how does the MPV respond to the changes in any of the variable? So if I change the sales revenue small, will it affect the MPV? If I change the cost of capital, will it affect the MPV? Then you are conducting what you call sensitivity analysis. How does the MPV respond to the changes in what? The variables. Good. Is the MPV highly sensitive to the variables? Meaning that the slightest change can cause a difference in the MPV. Or MPV is slow to react to the changes, meaning you have to change the figure by a larger amount before MPV will be affected. That's all. Now we have a major formula for doing that. So I'll give you the major formula, then we are done. So you can practice more of this. So to conduct sensitivity analysis, we said that don't worry, relax. The general formula is equal to NPV, because NPV is divided by what? Divided by the present value of that variable, PV of what? The variable that you are looking for. From sales, variable cost down up to the net cash flow, including the discount factor, down up to the PV, the present value. All of them, you can conduct sensitivity analysis on them. So NPV over what? The present value of that variable, we are done. That is the sensitivity analysis. And we know the reason. We just want to know by how much will the changes in the variable will change what? The NPV, or will affect the NPV. That's all. We are done. Yes. So for instance, if I want to conduct a sensitivity analysis on selling price, oh, then what do I do? Or sales revenue. I'll just tell the examiner is equal to the NPV all over the present value of the sales value. Sales what? Value. That is it. All over present value of the sales value. Good. So put all the sales value together from year one to the last year. Find their present value. You are done. So I'm done. Now let's go to the variable cost. The variable cost they can also ask you to conduct a sensitivity analysis on it. Then you are done. Profit, the same. Then when they ask you for sales volume, sales what? Volume. That's the sales quantity. Quantity or sales units. They mean that one use profit. Use what? Profit. That's all. So the formula will be the NPV over the present value of what? The profit. That's all. Times 100. All of them times 100 because it will be percentage. 30%, 20%. We are done. Now let me go to the critical ones. The critical ones. Some of them are stubborn. For them, they don't, how do you call it? They don't follow the general formula. There are two. If they ask you to conduct sensitivity analysis on the cash flow, just cash flow like this, cash flow, then the examiner is just asking you to calculate the normal payback period. Normal what? Payback period. So just calculate the payback period for the examiner. When they ask you to conduct sensitivity analysis on the cash flow, the examiner is looking for what? The normal payback period or the general payback period that we know. Good. That's on the cash flow. Good. What if they say net cash flow? Net cash flow. That means the examiner is asking you to conduct a sensitivity analysis on the net cash flow. That means they are just asking you to calculate for the adjusted payback period. Adjusted what? Payback period. Now let's go for the last one. Then we are done. Adjusted payback period. The last one will be conducting the sensitivity analysis on the cost of capital. Almighty. That one, you know it. And that's what we mean by what? The examiner is asking you to calculate for what? Internal rate of return. That's good news. So conducting the stubborn ones are 1, 2, let's go to 3. Conducting sensitivity analysis on cost of capital. Cost of capital. That is the same as what? The discount factor. That is the same as the discount factor. That is the same as the discount factor. Good. So conducting sensitivity analysis on the discount factor or cost of capital is same as the discount factor. They are just asking to calculate what is equal to internal rate of return. That's all. And all of these we are done. So that is it. So these are the sensitivity analysis. The one with percentage, if you calculate and it is high, if it is high, it means that you have to change that amount to certain value before the NPV will move. So for instance, you conduct sensitivity analysis on sales, on the selling price, and you have, let's say, 5%. It means that the NPV is what? Sensitive to the selling price. Even if you change it by 5%, the NPV will change. The NPV will do what? Change. If you calculate together, let's say something like 70%. 70%. If it's a human being, they will tell you that he will on Tuesday. Good. That means you have to change certain things, change the selling price up to 70% before the NPV will respond. That the NPV is slowly what? Sensitive to what? The selling price. I have to change the selling price up to 70%. If you calculate and it's, let's say, 1%, it means that in fact that item is highly sensitive to NPV. The slightest change that you do or the slightest changes will cause the NPV to change. That is it. That is the sensitivity analysis. Have you seen the interpretation? Aside these big three that come with their own interpretation, the one with the percentage, that's how you're going to interpret it. So it just explains how sensitive. The lower, the higher the sensitive. The higher the figure, the lower the sensitive. Like here, if you get 1%, it's highly sensitive. If you get like 70%, oh, but even 30% is not sensitive. That means you have to make changes up to 30% because before the MPV will respond. On that note, we are done with investment appraiser, capital budget. Kindly go through them for me and it'll be fine. So let me give critical questions that you have to go through them and kindly submit them when you are done. Please, the following questions are for practice. So question one, you are doing question one, try. Make sure that you have these handouts. Great. You are doing question one. And then question three. For question three, you've done it. So just go through. We've done question three, just go through. Then question four is the list or the buy. Question four. Good. Then the question five is the capital rationing. It's a capital ration, so you can try that one for me. Good. Question five. Then from there we jump straight to Yehuada Limited. Yehuada. Good, Yehuada. Try that one also. It's very good. Yehuada. Then from there we go to Kwame. Kwame, we've done it, but still go through. Ajasco, that's November 2017. We've done it. That's the first example that we solved. Ajasco, we've done it. This is the question I was talking about. That question is either after Mawana or before Mawana. Good, this is the question. Kindly try it. The maintenance manager of what? Prudence Limited. Kindly try this question for me. Then Mawana 2, I gave it out as work. I've not received it. I've explained everything in it, but I gave it out. I've not received the solution. Still pending. Don't worry, everything will be fine. Then question 14. Yes, question 14 too is a trial. So these are the questions that you are trying for me. And don't forget that there's a question here too that is still pending. And then in this handout too, Abrifa too is still pending. Yes, Abrifa is still pending. Good. This very one is still pending. So that's great. Good. So this is how far the good Lord bring us in terms of capital budgeting. Great.